right. Well, good morning, everyone, and welcome, Dr. Elliot Eisenberg, PhD economist extraordinaire.
Thank you.
Really? Hang loose. You're in Austin, not Hawaii. What's that all about?
It's like rock on, rock on.
Rock on. Yeah,
That's Spider-Man. That's Spider-Man. That's rock on.
Spider-Man.
It's very similar.
Silly me. Silly me. Well, good morning. Boy, it is a big week. Big week, isn't it?
It is indeed. Fed meeting, GDP numbers. Yeah.
All
It's also called Economic Week.
Yeah.
Yeah. Did
So
you?
the fact that we have you for Economic Week is a big deal.
Thank you. I'm honored.
They
Really.
planned it out so well.
All right. So for those who have been living under a rock, the Fed started meeting today and they will wrap up their meeting tomorrow. And we are expecting a 75 basis hike in the Fed funds rate. Correct, Dr. Elliot Eisenberg?
Absolutely. 75 bipper. Yep.
Okay. So tell us about that a little bit. So what effect is that going to have, if any, on our market? Has it already been built in? Tell us a little bit.
So actually, a 30-year mortgage rates have actually fallen a little bit, right? They're now down to 5.5 on the Freddie Mac survey. They vary in different places, but they've come down. And the reason they've come down is the Fed rhetoric between, say, literally Jan 1st and June 1st was increasingly harsh. We're going to raise more. We're going to have more hikes. Inflation's worse than we think. It should be worse, worse, worse. We're going to raise more and more and more. And then the rhetoric has become so strong, and the rate hike expectations are so big that now we think we're going to have a recession. And as a result of that, the 10-year treasuries come down from 3.2, 3.3 to now 2.9 or whatever, 2.8. I think it's 2.8 this morning or yesterday. And the thinking is, that even if the Fed raises short-term rates more, long-term rates aren't going to go up. They may even go further down because the fear of recession becomes even more certain. It goes from 75 or 85 to 95 or 100% certainty. So this interest rate hike at the short end will have absolutely no effect at all on the long end rates. What will affect long rates now is actual inflation data, and more importantly, what the Fed's going to do at the next couple of meetings down the pipe. And if they're smart, they're not going to tell us anything now. They're not going to give us no forward guidance because they themselves have no idea.
Okay, so I would just like to point out that we talked about this a few weeks ago. Powell literally sat there and said, we don't know. We don't know anything. Don't know anything. Our guess is as good as yours. Your guess is as good as ours. So that was crazy, wasn't it?
Hey, it's legit. I mean, no one knows the future. We ascribe to the Fed some supernatural powers that they know what's going on. They have a bunch of 500 or 1,000 economists with PhDs. No, if they knew the future, they wouldn't be working at the Fed.
Okay, so
Exactly.
part of me loves it that he was totally straight about it. I mean, part of me just thinks that's awesome. The other part is, holy crap, they're in charge of our monetary policy. Like what? How? I mean, that's not great. So which is right? I don't know which way to go on this.
Well, the thing is, you shouldn't objectively, markets put too much influence on what he says. They hang on every word. They hang on the notice that comes out at 2:00 Eastern time. And then at 2:30 Eastern time, he has a 45-minute presser or a 1 hour long presser or whatever. And we hang on every word, and the markets really gyrate based on that. But remember, they don't know anything.
Right.
It's just kabuki theater to entertain us all. I mean, look, they're doing their best, but look, they're behind the curve on raising rates. They should have raised rates earlier. They should have begun to shrink their balance sheet way earlier. And, look, I married my ex-wife. It was a mistake too. We all make mistakes.
Now, but
Oh my God, Elliot.
Inflation a year ago in August, September, and October was like around 0.3% per month. So
it was getting high already. It was already starting to move. That's right.
No. It was actually lower those 3 months.
Right.
Oh,
but that's
okay.
the problem is that this
so
year it's so much higher.
It didn't start going up until November. So, so they started raising rates in November or December. They started raising rates in what was it?
March, and they began.
They're off by a few months here or there. And, so.
Really, Kevin?
Credit.
Really? Really?
Just saying, how
oh my God.
Get their crystal.
No, you're right. Had they been really prescient, they would have begun raising rates in July or August, saying, oh, well, we know inflation is going to start to get a little bad come the fall and winter. We better be a little bit proactive. Or they should have, I think they could have actually cut their balance sheet earlier. Waiting till
Yes.
March to do that, that was a legitimate mistake.
Well, when was
In
the last
retrospect, clearly.
when was the last time they used the word transitory when they were talking about inflation? I guess that'd be an interesting study.
Probably December. I think when Powell testified in December, that was the last time he used it. Now, I think he's actually right. It will start coming down now, but it won't come down fast enough. That's the big issue now. How fast does it decline? Not does it start, has it peaked? It's peaked either June last month or this month or next month, it'll peak. But if it comes down, if it peaks and comes down really slowly, they'll keep raising. If it comes down really fast, wow, the Fed gets a break. They need it, but they won't get it, I don't think.
So
I think so.
how does raising rates by 3/4 of a point on tomorrow affect the economy today? It doesn't, right?
Great question. A million dollar question, especially given the economic problems we have today. So think of it this way. It affects it in the long run and the short run. In the short run, it's affecting the housing market already. You've seen it. Year over year sales activity down 20%. Year over year mortgage apps down roughly 20%. Year over year new housing sales are down about 20%. There's clear weakening in the housing market. Existing home sales, are now 5.1 million. Inventories going up. Days on market are rising, and so on. So the very most interest-sensitive sectors of the economy are already being felt. And housing is the most sensitive. Traditionally, automobiles were also very sensitive, but they're not so sensitive now because we're underbuilding automobiles by 4 million cars a year.
15% General Motors downstay.
Right. So the demand for cars is just unrelenting, and people overpay for cars above MSRP and so on. So cars don't help us. So it's only housing, and then it's also new construction. And you're seeing some slowdown a little bit there, but you're also seeing slowdowns in deals. LBOs, leveraged buyouts aren't happening. All kinds of how firms borrow money.
Yep.
It's changing. There's fewer deals. It's more costly. You're going to have to give up more equity to get a deal. Investors want to see firms that are profitable. So that's hurting. Firms now, manufacturing and activity, overall economic activity is peaking out. So all of a sudden firms are going to say, I don't want to invest in plant and equipment. That may take 5, 6, 7 months to be felt. So monetary policy has this short-term instantaneous effect on housing and autos, generally in construction, and then a much longer-term effect, 12 to 18 months, on the rest of the economy. Your credit card debt's now going to be 25%, not 21 or something. Think of it like eating a gummy bear. You take a gummy bear, you don't taste anything. There's no effect. So you take 10 milligrams, nothing. You take 10 more milligrams, nothing. 20 minutes goes by, nothing. One more gummy bear you take. And then after 30 milligrams and 45 minutes, bam, you get whacked in the face. That's what's going to happen to our economy come next year, when the rate hikes that we experienced in March, April, May, and June affect more than the housing market, but then they begin to affect the full economy. And that's why the recession likelihoods become really, really big. The hope of the Fed and their defense is to say, look, we can't make cars more than 13 million. That's all our economy can do. We can't fix supply chains. We can't get chips made for cars, semiconductors. We can't do that. So let's reduce demand for cars from 16 million or 17 million new cars down to 13. If we did that, price of cars would go back to its normal equilibrium price, whatever it is. So if they could slow the economy down just enough, things would be perfect. But the Fed never gets it right.
No, it's not good. What you're talking about is a potential soft landing versus the crash landing that typically occurs. So Philly Fed, their manufacturing numbers already came out as negative. They're not the first negative manufacturing numbers. We're seeing that. Walmart, where I do not shop, as my personal objection to what they did to small business in America. I've literally never bought a single thing at Walmart. Their numbers came out worse this morning than they were expecting. And because they're the largest employer in the United States, they were saying
them and Amazon are fighting it out.
Are they? Okay. So they're saying that that's a big deal and that's a big indicator of what's yet to come, right? Do you
food
think
inflation and energy inflation are killing households.
Right. So, do you think my little personal affront to Walgreens is really, not Walgreens, Walmart is doing anything? No?
Unless you spend a tremendous amount of money and your income has, as a loan officer is in the multi-billions of dollars a year. I suspect not. But I think the Walmart story is a meaningful story. Their profits down, and they say they're going to reduce the prices of some items to spur sales. This is telling us that the bottom third, bottom half of the population is essentially running out of money.
Right.
Their savings rates are down. The wealth that they accumulated during COVID is melting away. And therefore, they're struggling a little bit. In Britain, it's much, much worse. Real incomes are declining very fast, 4 or 5%, because wages aren't going up and inflation's worse. This is a problem. And then Fed's raising rates. And don't forget, fiscal policy is also tightened up a lot. Right. It's gone from a year ago, we were 4% stimulative fiscal policy. Now we're 3% negative. So from up 4 to down 3, a change of 7 percentage points on top of now tight monetary policy. That's more than an economy can realistically bear. And there's a war in Europe. Europe's going to go into recession for sure because the Russians have cut energy prices. The price has gone up and the supply has gone down. I mean, it's a double whammy for Europe, non-Russia Europe. And then, we have China with terrible economic growth because of their insane zero COVID tolerance policy, which is just way beyond its due date at this point.
Yeah. So a few things. Number one, it looks like chat is still an issue and people are figuring out that they can use the Q&A instead. And we do need to back up just for a moment to clarify that yes, indeed, you were using a THC gummy to explain the lag effect of higher Fed funds rates. So for anyone who was wondering why we were dying laughing, that would be it. And if you don't know what Elliot is talking about, visit your local dispensary and figure it out for yourself. So
I can't talk about a local dispensary. Come to California. We have plenty.
And for those of you who happen to be in Texas, where I am now, please refrain from this. It's illegal. I would never condone illegal activity.
Right. Make sure that you are checking the local laws to find out how it's going to impact you potentially. So, okay. So we've got 75 basis points potentially tomorrow. What's going to happen in September?
They're going to raise again. There's no question.
Right.
It's the thing is, it's going to get harder for the Fed to raise as the economy weakens. Up until now, inflation's been bad, the economy's been good. Yeah, GDP numbers are wacko, but other than that, they're good. So it's easy to raise. But now the blinking competition starts. So the Fed's going to raise 25 or 50 bips in next September. I don't know what it's going to be, one of those. And I suspect after that solid 25ers through the end of the year, we get to like 3 3/8 the Fed funds rate by the end. The question becomes,
anyway, wasn't it?
Pardon me?
That was their target anyway. So, I mean, we're kind of.
That's roughly their target. Right.
But where they wanted to be.
The economy's weakening. The economy will weaken. I mean, first time unemployment claims have been rising now for 5 or 6 months from a low of 170, which was remarkably low, up to about 240,000 now, which is kind of normal, but that's a 70,000 person a week increase in first time claims for unemployment, a pretty good proxy for people losing their jobs overall. This keeps going up. I mean, the yield curve is inverted and so on. Will Powell blink? If he blinks and says, I'm not going to raise rates after December because, whoa, the economy is really softening, the fear of recession is palpable, that would be bad. He has to really follow through with this and squish the inflation out of the system before he can really lay off interest rates and damn the recession consequences to some extent. Because if he goes on, off, like they've done in the past, the 70s and the 60s and 70s, you end up with rising inflation rates over time.
So I'm thinking from here, from San Francisco, and what I'm seeing here, we have a lot of startup companies, and a lot of the venture capitalists are actually instructing companies to start cutting now. And they're cutting employees ahead of a recession, not waiting for a recession. And that thus causes a recession, correct? I mean,
it certainly helps it along. The fear of recession changes our behavior, right?
Yes.
And the behavioral changes more quickly induce it, or more likely to induce it. We'll spend less, firms will pay less for salaries, they'll lay off workers and so on. Yeah. It's to some extent the self-fulfilling prophecy. Absolutely. Yeah. So yeah, we're our own worst enemies. That's why Audrey should go out back to Walmart now and spend, her $100 million a month salary all on diapers and whatever,
Patio furniture. They got a lot
patio
of
furniture,
sale.
pavers, pergolas.
I'm a
But
little
yes.
nauseated. I feel like I'm having an allergic reaction to the idea of doing that. That's never going to happen for me. Just like I will not be driving a Prius, Jill James. So
Spend the money elsewhere. Just spend it. I mean, we're seeing, for example, household spending is
Yeah.
last month was softening. Retail sales are down. Yeah, big deal. We've bought a lot of retail stuff. It's services we want. But if you add services and goods together, they're going down. All these, rarely do you have all these signs sort of before the Fed raises rates.
Yeah.
The Fed's only raised 3 times, a 25 bipper, a 50 bipper, and a 75 bipper. And we already have all these clear data that things are weakening already. This is not a good sign. Usually, it takes a while for the signs to turn bad. Now they're already bad before they really have meaningfully hiked rates.
Well, so the consumer confidence index was down, and it came in down and below expectations, right? So
I'm looking at the Edvard Munch painting.
Wow, that's it's quite a look. You can almost
You wrap
market
yourself
that.
up. That's pretty good.
Edvard Munch, marijuana. I mean, we're trying to cover all the bases.
Wow. I mean, you're definitely putting a whole new spin on mortgage economics. And so let's just talk about the European Central Bank right now, who
But consumer confidence is terrible. It is absolutely horrible. It's real wages declining, inflation's crummy, the economy's weakening, COVID's wildly, everyone's getting COVID now. Biden just got it, for example. I mean, he's protected as well as anybody is. Good God.
Okay. All right. So I just had COVID for the second time in 7 months. I am vaccinated, boosted, and it was a cold, maybe not
Right.
even. I mean, like if it wasn't rude to go out of your house during, when you had it, I would have just kept going because I was not sick. And I know that's not how it is for everyone. But I was talking to a nurse client of mine, and she said, we really need to stop counting the infections and look at who's in the hospital, who's on a ventilator, and who's dead.
Hospitals and death rates. And those are flat. Death rates are flat.
And I'm not in any way discounting any of that. I have some friends who recently have had COVID and they really didn't feel good. Nobody was in the hospital. But again, we're talking about, when we are talking about potentially, shutting down economies, et cetera, that's a whole nother conversation that
you're right.
Try to stay away from.
But no, but I look, the infection rates are no longer valid because so many of us do the tests at home ourselves. And then we go hug our mother-in-law or something when we discover that we're positive.
I wouldn't do that. Would you do that?
No, never.
I do know people that would.
Yeah.
I'm just giving people ideas. Anyways, so the data the only valid comparable data over time is the hospital admissions and the death numbers. That's it. Ignore infection rates. And those numbers haven't really changed. The death rates have not changed. The hospitalization's up, but because of the Evusheld and there's another drug they could take, that people aren't dying nearly. No, it's much less severe. Yeah.
So this is not to discount any of it. It's just that, listen, we got to keep our eye on the ball of what is really, really impacting things. Okay, so going back to recession, just a reminder to everyone, because we have this acronym NBER, National Bureau of Economic Research, and they are the folks, even though we always thought that it was, just 2 negative GDP quarters in a row. No, the National Bureau of Economic Research is the one they call recessions, right? So tell us a little bit about that, because it's always going to lag a little. We're not going to hear we're in a recession till when, if we are in one.
Yeah, we won't find out we're in a recession until 7 or 8 months after it began. So waiting for them to give you the all clear sign, not a good idea.
But I can tell you we're in a recession right now. Me personally, my income is down from last year. Therefore, I'm in a recession.
All right.
So
look,
I think I should be on this panel because I think I could call it faster than they can.
That's for sure. But they look at objectively. Look, different sectors of the economy, like you guys were booming in late 20, early 21. You guys were living large. Then things reversed. But it's the overall economy we care about here. And they look at a bunch of different things. They look at industrial production, employment numbers, GDP. GDP is just one of several things they look at. And traditionally, the idea was we want to see a meaningful decline and over a period of time. And so that's why when the last recession we had, it was just 2 months, that kind of violated the rules in a way, because a little GDP decline is not enough. It's got to last over a while. Now, the GDP decline in 2021, 2020 was so brief that it wasn't, but it was so steep. It was a literal 10% decline in GDP in 2 months, 10%. That's 40%, 30% annualized. I mean, crazy numbers we had for Q2.
Yeah.
So they changed the rules to fit. I mean, they want to get meaningful declines across the board for a length of time. That's what you think about. And just because GDP fell for 2 periods in a row, 2 3-month periods or half a year, it's weird off one things. It's inventory nonsense. It's the decline in government spending. Oh, it's imports that skyrocketed. The ships that were offshore in LA and Long Beach suddenly get unpacked. It's weird stuff. It's not meaningless, but it's not it's not telling us what the US economy is producing. It's telling us some weird imports, fiscal policy, and inventories. Not meaningless. But you look at the underlying data, it's been pretty good through June. It really has been.
All right. So we've got a comment here from our friend Michael Simmons. He says, companies for the first, Elliot, Dr. Eisenberg, companies for the first time have reason to raise costs, shortages, supply chain tribulations, increase wages, though still behind inflation, etc. Do you really believe that they will lower prices in the short run when even with flagging demand, the solution to the other issue require long-term fixes?
I think there will be some decline in prices. Absolutely. When hotels are no longer full, suddenly, and their occupancy rates fall from, I don't know, 90 or 85% to 75%, hotel prices will come down. There'll be more competition on Expedia and Travelocity and Trivago and all those websites, right? Yeah. Airplanes also, eventually there'll be more pilots, there'll be less demand, there'll be empty seats, and then prices will come down too. Automobiles.
I've actually heard hotel stays are down right now because everyone's in Europe.
Oh, okay. There you go. So, I mean, this is, yeah, there's now we can argue how much competition other sectors there are. There isn't enough competition, automobiles, or for example, cell phones or whatever it is. So, but prices will absolutely come down.
Yep.
Used car prices will not stay where they are.
Apple announced this morning they're dropping prices in China for iPhones.
There you go. Weak economic conditions. That's what you have. Do you want to keep your market share or not? Now, are they going to go back to where they were before the inflation of the 2021 cycle started? Okay, we could argue that one. I think there's been some permanent increase in costs. Labor costs really have gone up, and this reshoring of production. We're going to do more in Mexico or more in Eastern Europe or more in South America or whatever it is, or even some here in the US and Canada. That's going to raise costs necessarily. That's mildly inflationary too. So prices will not go back to where they were, but they'll come way down from where they've been.
So that's good.
I had an observation last week. I wanted to throw it by you. So
he had a brilliant epiphany once, and he wants to revisit it.
Go
ahead, Kevin.
It's scary when Kevin has an idea. I worry.
Yes.
I know. Pay attention, everyone.
The comment is that in Europe, their feds, because they have different feds, they can't raise the rates as much as they can in the United States because mortgage rates in Europe are tied directly to the Fed rate. They're all adjustable loans. We don't have all adjustable loans. We have 30-year fixed. So raising rates by the Fed doesn't hit the customer or the consumer straight in the pocketbook.
Yeah, they've got several problems in Europe. That's one of them. Almost all mortgages are readjusters, 5 years, 3 years, 1 year. It depends on the different countries, right? So the European Central Bank, the ECB's got a problem. The second problem the ECB has is the Southern European countries with very high debt loads. So as they raise rates, countries that are weaker economically see the gap, the spread between German bonds, which are the best bonds in Europe now, in the Eurozone area, and it's Italy, which is the worst. That gap is now widened to 200, 250 basis points. That's a huge amount of money. And if this continues for too long, it becomes what they call a doom loop, because the Italian banks own the Italian debt. As the Italian debt yield spreads widen, the value of the debt declines. And the banks can't make loans because their capital reserves are under pressure, and you get a disastrous outcome there. The third problem that they have is the inflation in Europe is generally being driven by energy. It's not exclusive. Here in the US, it's more demand-based problem. There, it's a more energy-based problem. And you can't fix an energy-based problem by raising rates. The Russians aren't going to produce more oil, So you can crash your economy to reduce oil demand by 1 million units. I mean, that's a terrible solution to an awful problem. Here in the US, it's easier to reduce demand. We don't have to reduce the oil price. Demand alone will help us reduce our inflationary problems, not in Europe. So they have a much more serious problem, and they have much less flexibility because of Italy and the housing issue.
So they raised 50 basis points the first time in 11 years that they've raised rates. What did they do next then?
I think they're going to try and see this. They developed this anti-fragmentation device, they call it, which essentially means they can buy unlimited amounts of Italian debt, Spanish debt, Portuguese debt, Greek debt, the pigs, if you will, assuming those countries behave themselves in other areas. And they're going to rely on the IMF, I think it is, or some other institution that gives them a seal of approval that their balanced budget is not in deficit. And, they're doing fiscally responsible things, not being profligate. So now the question becomes, will the IMF or whoever it is, this other body, give them the seal of approval, letting the ECB buy tons of their debt to keep their interest rates down? It's a mess. Europe, and they also grow more slowly than we do here in the US generically. And their currency is really weak, which is causing all kinds of inflationary problems to boot. So they have bad currency, weak currency, fragmentation, variable rate loans. Wow. We're in much better shape.
So let's bring it all back here, shall we? Does this impact us here? And if so, how?
Yes, it does. No question. Okay. Europe goes into recession. Germany is probably already in recession. Europe goes in recession. Britain goes into recession. Canada will go into recession as well. We will follow them as well. It's almost inconceivable that the Western world goes into recession, and China slows dramatically, right? China's GDP growth last quarter was 0.4%, the weakest they had since COVID, and before that was 20 years ago. So China's drastically slowing as well. So you have slowing and you have recessionary economies, and the emerging markets, so India, Thailand, Philippines, Malaysia. Not that they're so important, but they're also weakening dramatically as the dollar strengthens and our rates go up. And you have a synchronized increase in central bank interest rates around the globe.
Right.
For us to avoid this it would literally be a miracle.
Okay, so let's just assume it's not going to happen.
So all this adds gas, fans the flames of the recessionary fire, if you will.
Okay, so we have a question here. Can we talk about how Biden and Yellen want to redefine the definition of a recession?
I haven't seen that yet, but I've certainly seen Yellen, a number of comments that she's made recently saying a recession can be avoided. We're not going to probably go into recession. They're desperately trying to play. And I think what you have to just scoff this off is saying, look, they're government. They lie to us. That's what they do for a job. Wow. I don't mean to say that in a negative way, but they're going to put the best possible spin. By contrast, the Republicans are going to say, oh, terrible policy, awful administration. They've created the recession, blah, blah, blah. They helped it, aided and abetted it. Yeah. But if the times were reversed, the parties would be saying exactly the opposite things.
Yep.
So yes, Yellen doesn't want to be the treasurer who helps create the recession. So she's going to try and squirm and scream as much as she can and avoid saying it. And then if it happens, it'll be brief.
So it's kind of like back in 2008 when they called it a recession when it was actually a depression, but they didn't want to say the D word. So now they don't want to say the R word. Is that what you're trying to say?
Pretty absolutely.
And by the way, they put great in front of it, of whatever word they use, which irritates the crap out of me.
That was the 2008 one. That was a great recession.
Yeah,
right? That was the worst since the depression.
Which I have maintained over and over again. There was nothing great about it. We need to call it anything else and move on with our lives. Okay, so I have a comment. Good morning. The whole administration should be fired. Not one of them knows what they're doing. And just a reminder that Powell was appointed by the previous administration and that they are all in this together, like in my opinion.
The important thing there is to look at the votes. If you look at every 6 weeks when the Fed meets, they vote on the statement that comes out and the policy regs.
Right?
What, pardon me?
It's called a dot. What is it called? The dot.
Oh, they have the dot plot every 3 months. So every other meeting, they have a dot plot. But every meeting, they put out a statement of their monetary policy intentions, raising rates, lowering rates, or keeping them unchanged. And everybody votes on it. There are always 7 plus 5, 12 voters who can vote, 12. Some of there are vacancies, so it's 11 or 10 or whatever. But you only see at most one person voting against the group. So it's 10 to 1, 11 to 1, 10 to 2 would be a violently aggressive anti-policy stance position. So you get them all agreeing. You have the 7 governors of the Fed appointed by the president, and that's both Trump and I think there's even one holdover from Obama still. Wow. You have the 5 voters of the Fed regional banks, of which there are 12, and they take turns essentially. Right. And those are all appointed by the independent Fed banks. So to say that there's groupthink at the Fed is really not true. I mean, they go native because they all want to get along and be friends, of course, but they all come with their own perspectives. And those are virtually unanimous votes every time. This last one, the 75 Bipper, was 11 to 1 vote, and only one person who opposed was Esther George, if I'm not mistaken, from Cleveland. She won 50 bips. I mean, not a vast difference here. So there's generally unanimity of agreement. They talk and they figure things out and they make a decision. It turns out to be completely wrong sometimes.
Yeah, well, considering they're all academics and have very little on the ground experience.
Some aren't. Michelle Bowman's not, to her credit. And I think it's good to have, although I'm an economist, I think you need to have some real world people in there who have real experience as bankers. Yeah. And the Fed bank presidents often do. They come from, granted, they often come from investment banking houses like Goldman Sachs or Merrill Lynch or something, which isn't
exactly
the real economy.
The business in America, Elliot. Jeez Louise.
No, but they now have one seat. Michelle Bowman's seat has sort of become the community banker seat. And those are non-money center banks. That's a good thing.
So 1 out of 12. That's great. I think.
Thanks for that slap down there, but okay.
I just want to know whether you have any thoughts on whether they go in there and just flip a coin. No? Yes?
No. Their results may be no better than flipping a coin.
Right.
But there's a lot of thought that goes into that flipping, let me tell you.
Yeah, exactly.
That's why you shouldn't pay attention to what he says. The market pays attention, and they shouldn't. He got it wrong earlier. They'll get it wrong again. They'll get it right. It's to some extent luck and some extent experience, but it's just the way it is. The market shouldn't pay so much attention.
Yeah, but they do. Okay, so there are vastly different opinions on what the housing market is going to do in the, let's call it the next year. I have heard everything from we've hit a bottom, everything's going to get better now, to it's going to tank and everyone's going to lose their houses. And so to that point, I certainly have an opinion. Tell us what you think.
Let's get that coin out.
Yeah.
Audrey, where's that coin? Oh, tails, it's going to get worse. So I think it does get a little worse. There's no question. The interest rate, you have a combination. House prices data came out today from Case-Shiller or CoreLogic or somebody, I'm not sure who came up with data today, showing house price appreciation through May, albeit. And if it was Case-Shiller, it was March, April, and May, so it's even more backward looking.
I think it was Case-Shiller.
So then it's March, April, May, a combo, a third March, a third April, a third May. So we're still quite backward looking, but the number was still 21%. So even with the high rates that hit in April, May, we didn't have a big decline in May of house. We don't know what the May number is alone, but this increase in home prices and the high mortgage rates have to affect people. There's no doubt about it. Yeah. So I think it falls a little more. Existing sales fell to 5.1 million, right? 5.14, whatever it is. I think it falls to 4.7, 4.8, 4.65. So we're getting close to the bottom. And of course, when the recession hits, the Fed at some point next year, early next year, mid next year will say, well, we're done. We're finished raising rates. They begin to lower rates and the economy improves. So this is on the buy side, a short duration problem where it goes from now until next summer, things get worse a bit, and then we kind of bottom out, we're done. On the refi side, there it's a more serious issue. But now they'll also benefit from the rates fall next summer, whenever it is. Then people who bought a house over the last 12, 18 months will go, whoa, I can refi. Right. And there should be a push towards adjustable rate mortgages too, right? They're not, look, the yield curve's inverted. So when the yield curve is inverted, getting an ARM is not nearly as beneficial as just under normal conditions. That said, for some people, a 5-1, a 7-1, an 8-1, a 9-1, and whatever they are, ARM is beneficial. So there's always going to be some refi, but refi is not going to get worse than it is. It's done. It's down 80% year over year.
Right. It's down 80%. But you know what I thought was interesting? NBA released their numbers. 31% of the market is still refis per NBA.
Right.
That's
Yeah.
crazy to me. I was like, holy smokes, is that real?
Yeah,
But people,
cash out.
but it's cash out. It's
Yeah.
what-
No, I get it. I'm just saying. So to folks who are listening who think, oh, well, there's no refis, 31% of the market, that's not a small number. So I found my notes, by the way. So Case-Shiller appreciation for May, and again, this is before rates kind of topped out. What
it was 20.6, I think, or something. Right?
19.7, it was up
Oh.
1.5%. FHFA's home price, which measures conforming loans,
Right.
they were up 1.4% in the month and 18.3% year over year, which those are crazy numbers. So
These remain crazy. Now, as
Yeah.
inventory rises, and it is rising, NAR inventory numbers have doubled since January from 1.5 months of inventory to 3 months, still a seller's
way under.
market. But
Mhm.
as it goes up to 4 or 4.5, we should begin to see price appreciation really should start coming down to 6, 7, 8%.
Which would be great. Those are
better.
great numbers.
Much better, much healthier.
Yes.
And then if rates fall, in 8 or 9 or 10 months from now, which is reasonably likely,
Yeah.
so suddenly things turn around again. So this is a short-term problem. It can be serious, but don't think this is a permanent state of affairs. And importantly, the housing market is not like it was in 07, 08, 06, 07, whatever those years were. Look, homeowners have tons of home equity. Even if you bought a house a year ago, you're up 20%. So you could lose 20% of equity and still be at zero. And you put 10% down, probably. It wasn't a 105% mortgage. The inventory of homes remains tight. Builders are going to stop building in a hurry now. They won't be adding on for ghost buyers, right? The credit conditions are stronger. There are REITs that are buying single-family homes for rental purposes.
That's
You can
not a
argue
good
whether
thing.
that's good or bad.
That's
Separate
terrible.
conversation.
That's terrible, Elliot. Get that straight. Terrible.
Okay, I agree with you. I'm flipping
Thank
the coin.
you.
Tails. I agree with you. It is terrible in the long
It
run.
is terrible.
So the housing market and the demographics are very favorable to home buying, unlike the situation 13, 14 years ago. So we're not going to see the declines. Again, 4.5, 4.75 million from now 5.1 should probably be the bottom on the annualized rate of existing home sales.
Sorry, I'm having a whole thing over here. Apologize. Good Lord. Okay, so mortgage delinquencies are higher in June. What a shock, considering we don't have a foreclosure moratorium anymore. So just to be clear, because we are very big on making sure that people remember that we do not just follow headlines here. So foreclosure starts increased 27% in June. They landed at a total of 23,800. That is still 40% lower than pre-pandemic levels, even though if you watch the headlines, it is 441% higher year over year. But again, people, we had a foreclosure moratorium. No one could be foreclosed on. I mean, there were some, but mostly no. So we are way below pre-pandemic. Make sure that you are getting the word out there, as these headlines make it look like the sky is falling, and it is not.
Correct. Well said. Bravo.
Wow, thank you, Dr. Eisenberg. I appreciate the confidence from you.
Yeah, it's the percentages when you get to these very high or very low numbers now, like inventory numbers are really, really low. They were very low in January, bottom Jan, Feb, March. Now they've gone up. It's 100%, 200% increase in inventory. Yeah, but if your inventory was 4 units and now it's 12 units,
right,
in Santa Clara County, it's like big deal.
Right.
So you've got to look at both the actual number and the percentage to make sure you're getting the true story at these turning points in the economy.
Okay, so I'm going to ask you to explain something in very simple terms that even I can understand. So we have inverted yield curves, right? All over the place, not just
yes.
No, like all of them are now inverted, and it should get worse tomorrow or better, depending on your perspective, once the Feds raise 75 basis points, right?
Right.
Okay, so we have arms. And by the way, most of them are like, they're not ones anymore, because it's not like 1-year treasury, right? They're sixes, because they're now adjusting every 6 months, which, by the way, is important for us to understand, because our clients are going to have a difference in payment potentially every 6 months instead of once a year. So what's happening in the short term matters more than it did previously. Can we
Well
agree
said.
on that? Okay,
Yes.
once it starts adjusting.
And they're based off SOFR now and LIBOR and stuff like that. SOFR's not the same, whatever. Yeah.
Right,
It's the market that's readjusting and learning new things.
Exactly. And again, just a reminder that you are never, ever, ever, ever to refer to any part of those loans as a fixed mortgage, even the part that doesn't move for the 3 years, 5 years, 7 years, 10 years, or you will have the CFPB right up your tail taking offense. Okay. So when you have, I just closed a 7.6 and I had locked it in, at a decent rate. It was in the 4s. With an expectation that my borrower is going in doing huge renovations and they're going to have blah, blah, blah. We're going to refinance down the road, right? We have an exit strategy in mind. So with these arms, do you have an opinion on them? That's really what I want to know. And how does it affect what is the correlation between an inverted yield curve and arm rates?
All right. So under normal conditions, short-term rates are lower than long-term rates are 5%, let's make a number, 5%, and short-term rates are 3%.
And explain
if you
why.
get an arm,
Explain
because
it.
the lender, the longer the lender gives you the money for, the more risk the lender takes. They take interest rate risk. Rates can go up and down over the course of decades. And there's credit defaults. The longer they lend you money, the higher the probability you will lose your job, die, get a divorce, get cancer, whatever it is. So to indemnify the lender, you have to pay the lender more money to lend you money for longer. So normally the yield curve's upward sloping. This is a 1 year, 2, 3, 5, 10, 20, 30 years, 1%, 2%, 3%, 4%. I'm making up the numbers, but you get the idea. So if you do a 30-year mortgage, you pay that rate, whatever that rate is. If you do a 5-year arm, you're paying more like the 5-year rate. The 5-year rate's less than the 30-year rate. Spectacular. But when the yield curve inverts, it all goes kablooey. The short-term rate is now higher. The 2-year treasury is now 3. The 10-year treasury is 2.8. So some of the benefit that you get from going down the yield curve goes away because the yield curve is inverted. This is a weird time, but it makes the arm a little bit less appealing than it would otherwise normally be. You'll still save some money by doing the arm, but you may say to yourself, the client may say, I thought I'd save 100 basis points. I'm only saving 60 basis points, and I'm not prepared to only save 60. I want the certainty of the 30-year.
Yep.
So some people are going to refrain from the arm because the yield curve's inverted, and therefore the savings gap is shorter than normal. Right. That makes sense.
And you're taking risks that the rates will go up, and you're taking risks that it's going to cost to refinance. So you're most likely better off doing the 30-year right now, just the way the economy is.
Correct. The refi costs are real. It's $10,000 to get to reborrow from tabula rasa. I'm not sure what it costs to do a refi. It must be cheaper. You guys know it. I don't know what it is. And the fear is maybe rates only go up from here. I suspect that's not quite the case, but who knows?
So the point was made that CoreLogic owns Case-Shiller, and yes, we understand that, but they do separate surveys. So
yes.
And somebody else made the comment. An anonymous person made the comment, 31% can't be right on the share of refis in the market. And I'll double check with MBA, but that Mortgage Bankers Association is pretty solid on their numbers.
And they put their numbers out every week. They put out weekly. So
Yeah.
it shouldn't change that much from week to week either. Right. You have to get some weird spike up 1 week on refi.
Yeah, right. Well, and maybe it was an aberration. Who knows?
But remember, there's divorce, there's death, there's disease, there's job loss. All those things just keep happening regardless.
I have a cash out refinance going right now. I'm waiting for the court to say yes to the offer that my buyers gave their spouse. But yes, it's happening right now.
Just happens. Yeah.
Divorces. I just got a loan for a divorce also. It's like they keep happening.
Yeah.
Right. May even happen more when bad times are bad.
Yeah, exactly. Okay, so I read this really interesting, I thought it was interesting article, which when all these companies were going public during the last few years, real estate companies and mortgage companies, and I kept thinking, holy guacamole, like you're doing valuations based on the best market that we've ever had. And Who in their right mind would think that that's okay? So listen to this. From a collective high of 76.8 billion, these 12 firms were worth 19.1 billion as of July 14th.
More than I thought.
A decrease of 75.2%. Not surprising for anyone with half a brain in our industry.
No.
But what the heck, and how do these companies navigate forward? Like we're watching stock prices tumble all over the place, right?
I think,
What happens?
and look, companies like Rocket or whatever they're called, that's not their real name. The one in Cleveland, right? That's the one. And then there's UWM, I think, is another big one that went public. Look, these companies do have an edge over smaller firms, and they can get Wall Street money. They're followed by investment bankers and so on. So they can take even though their share price is much reduced, they're not going to use shares to buy a company now because the dilution is going to be horrible. But they have easier access to money. When things improve, they'll improve faster. They can hire people from the weaker companies that go belly up. They can hire smart loan officers or managers or whatever, C-suite executives and whatever it is. So they do have an edge. But look at airlines. Airline prices go up and down like a yo-yo too. This is a home builder stocks go up and down a lot too. This is now one more, and they're even more up and down because their refis are swing much more than the new home sales activity does. So it's an inherently very risky market. But if you can call it right, if you know the housing market cycle or the refi cycle, wow, you can make a killing on this. I'm not even trying. But those companies, when they went public, they did it at the peak of the market, as you said. Yeah, refi activity was booming. You guys like you, loan officers, you weren't sleeping at night. You were working 24 hours a day.
Right. That is true. So
you got to hold back and say, don't invest all your money in these firms. That would really be a bad idea.
So at this point, if you, this is really an unfair question. You can tell me to, stuff it if you want. If you own those stocks right now, do you sell them or do you keep them? Just keep them?
You keep them now. I think holding on to them now is almost like an option. They're so low that the downside risk is pretty much gone. The upside risk is just a reasonable amount of upside potential here. Yeah, I'm not sure. I'm not even against buying them at this point. I mean, I'm not giving you financial advice. Don't sue me.
No. We don't do that on this.
Talk to your lawyer, your accountant, and so on. But at this point, I think there's more upside than downside because how much worse does it get is the question. How much worse can earnings get on these companies?
Right, exactly.
Some things there is still further down. Like I'm thinking like Bitcoin and that kind
of
crypto.
Crypto could be worse. Yeah, crypto could absolutely get worse. But I think the refi and the new housing existing sales are closer to the bottom. They're really close if they're not quite there yet.
Right.
Okay, so somebody confirmed that 30 to 31% for refis is right now. So I really do try to make sure that these numbers are solid before I start throwing them.
If you have, like you guys, the two of you, for example, you've been in business for a long time. You have a solid book of business and people. You know how to manage through ups and downs. You've done it before. You'll do it again. You'll get through this. It'll be fine. 2022 is not going to be your best year. Okay. But move on. You didn't buy 3 Ferraris last year when it was a great market. You only bought 1 or 2. So you have a little bit of cash. You get yourself through and things will be fine next year, whatever it is. It's more difficult for the people who just entered a year or two ago, were making money hand over fist, had never seen a declining market or a rate hiking cycle and blew all their money. Okay, they are in for a more difficult time.
Oh, we've talked about that ad nauseum because I mean, you've got realtors who've never negotiated before. That you have people who've never had to pick up the phone and say, "Hey, this is an issue," and so it is a completely different world. So we're going to take a moment, and I'm going to ask for a favor from everyone who's listening and anyone you can get to, including but not limited to the garbage man or anyone else that you trip over today as you walk down the street. We now have a Facebook page, Mortgage Pros 411. I would like to ask you to please go to it and like it, because apparently there are certain things that we can or we can't do until we have like over 100 likes. So we just did this last night, and so nobody knows about it yet. So please, if you could for us, we would really appreciate that. And Elliot, I don't want to forget to make sure that we let them know how to subscribe to your daily little.
Thank you.
It is short. It's not little. It's short. You have a very short little economic blip that you email out every day. It is free. It is really entertaining and enlightening sometimes. And you come up with the most random subjects. I mean, like, you will look forward to reading this every day. So if you could please prepare whatever it is that you typically will hold up and flash for everyone so they know how to find you.
I will do it. What you want to do is you want to text the word bow tie, BOWTIE, to the 5-digit number 22828. I'm going to put it up here on the screen. Hopefully you can see it.
Okay.
Bow tie to 22828.
22828.
And then you'll be prompted for an email address. Bow tie is one word, not two. One word.
Got it.
Uppercase, lowercase, doesn't matter. One word. 228. You'll be prompted for an email address. Give me your email address. You'll get some stock replies saying thank you for subscribing, and you'll start getting my stuff tonight. Thank you. Again, 22828 bow tie.
We love having you on here. Absolutely.
And what's your website, by the way?
Oh, Mortgage Pros 411. It's not we're just getting it up and going. I noticed yesterday you couldn't even sign up for today's thing on there. So we're trying to fix that, but we are really working hard on upping our game. So hang on a second. So somebody said they couldn't find it in here. And hang on, I'm looking right now. This is not exactly the best use of our time, but
well, I will not stall for time, but I want to share a thought with you guys.
Yes,
and it's
please.
The recession comes. How long does it last?
Yes.
How bad is the recession? Rates, the big question is inflation. If inflation doesn't come to, if inflation really persists and the Fed can't lower rates because of that, it can go longer. So it really depends on the speed of the decline in inflation. I suspect that it really does begin to come down at some point next year, meaningfully. But rents right now are the biggest problem. Rents are 35% of CPI. So even if goods inflation goes away, which I firmly expect, as trucks are being unloaded, firms are producing more, demand is falling for Pelotons and so on, rent inflation may become the biggest problem that we've got. Watch it like a hawk, be it shelter, be it primary residence, or be it OER, owner equivalent rents, what your house would rent for if you rented your house to yourself, so to speak, which is an important question. It seems bizarre and archaic, but it's not. Because if suppose Audrey had a house and I have a house, and then I live in mine and Audrey, you live in yours, no one pays rent. But if I rent your house and you rent my house, GDP goes up. That GDP can't go up merely because we rearrange. That's stupid. That's why you need the OER. But all these rent measures together are a third of CPI. Watch it really closely. It may give the Fed a lot of heartburn.
Okay. So, and yet another reason to get people into homes where you have a fixed rate and a stable payment.
More control. And that's another thing. 13 years ago, rents were declining. So your house was upside down and rents were falling. Well, default on your house and get a cheap rental.
Right.
But now rents are going up. So
right.
It discourages people from moving from ownership to rental. They'll struggle to stay in their house because rents aren't much of a bargain.
I had that math yesterday with a client who was looking to downsize, but then he's like, wait a minute, the condo to rent is going to cost me more than my house is paying for the mortgage. Like, why would I do this? This doesn't make sense.
Cash flow is not going to work. Right. Yeah. So this is not 07, 08. Do not think we're going to crash and burn forever in years and years and years.
Yeah, there was an economist who came out yesterday. It was like, oh yeah, it's going to be like 2008. The heck
I think it was Rubini who said that, Nouriel Rubini, it may have been. He made a great call back in 08 or 07. He was spot on. I mean, he was spot on. Since then, his spottiness has increased or decreased or whatever the case may be. It's very hard to get 2 or 3 calls right in a row. That's the problem you have. Every race has a winner, but the winner isn't the same winner from every race.
Right. Now this guy was Jose Torres, I think it was his name.
Got it.
And it was like, where are you coming for this? It's like I dug
it. Also sells papers. People buy it. Oh, it's terrible news. Let's read it.
That's what I was looking at. Is like, I think what you do a lot of time, we talk about this, the headline will say one thing and then you read the article and it's no, that's not what's happening.
That's
so
also
Elliot, hold up your thing again. People are asking for the information. It is 22828 and you do bow tie. And
this is your email, is your website, Mortgage Pros 411 on top.
Okay, but they're looking for you. So bow tie is BOWTIE, one word, and 22828. Okay, so Grant says that he found it, and we have 27 likes, which considering we nobody can find it, that's a miracle. So thank you. And maybe what we'll be able to do next week is get a link up there. That would be smart, wouldn't it? Okay, so bow tie, one word, BOWTIE, Joseph, and 22828. And so you will enjoy that immensely. I want to talk for just a second about who is coming up next. Next week, we have Bill Lohman. Oh my God, I didn't realize that. I love him. We all love him. So
he's good.
He's great.
He's
Rob
great.
Christman is the week after that. Then Josh
Whoa.
Pitts. Aaron D, who is the COO of Loan People, will be on the 23rd of August. We have Mark McArdle with the CFPB on the 30th of August. We have Dave Stevens on September 6th and Barry Habib on September 13th. So we have a lot to look forward to, but it's very hard to top you, Elliot. We love you so much.
Thank you. It's always a pleasure. Get me back on. I look forward to being on after whoever, Barry or whatever. All good people. They're all great people. You got a great lineup. You really do.
Well, if anyone has a suggestion of who you'd like us to have on here, please let me know. My email address. Well, of course, you, Elliot. You're always on our mind.
Number one.
But email Audrey at mortgagepros411.com. mortgagepros411.com. And okay, so I'm hearing, I'm getting a couple of texts from people saying they can't find it. I don't understand, like one person can find it, the other person can't. I don't know what the disconnect is. I'm sure it's in Facebook. It's some dingy thing that we could probably figure out at some point. So anyway,
we'll go back, we'll figure it out tonight.
All right, you're getting love notes on here, Elliot. I don't know if you can see them or not, but with that, you guys, we are at the top of the hour. These hours go so fast.
They go quick. They go quick.
There's so much to talk about. So we can't wait to see what the Fed say tomorrow. And just be careful, guys. Make sure you're really watching it. Do not be messing around with your clients' rates. Okay. All right.
Right.
With that, we will see you soon, Elliot, Dr. Elliot Eisenberg. And to the rest of you, we'll see you next week when we have Bill Lohman. Mwah.
Thanks, guys. Thank you. As always. Thank you. Thank you.
Have a great week. Bye.
Bye. Thank you.